So pro forma financial statements is our next learning objective. What are they? Very simply, the income statement or P&L, profit and loss statement, same thing, the balance sheet, and the statement of cash flows. And I build them in that order. Income statement first, because usually you get sales estimates from your marketing folks first, and then you figure out your cost. You go down to the depreciation line and depreciation expense line, take a break, go over to the balance sheet real quickly, see if you need any capital investments in the form of PP&E, property, plant, and equipment. And if you do, you depreciate it. If you select a depreciation method, calculate depreciation expense, and then come back to the income statement and finish it off. And then go back to the balance sheet and finish it off. And then do the statement of cash flows third, because it is simply net income plus depreciation plus changes in the balance sheet, essentially. Quick and dirty way of looking at the statement of cash flows. Pro forma financials, that is your first step in evaluating these big investments. So I do an income statement, a balance sheet, and a statement of cash flows. And I started turning these various assumptions into cash flows. So income statement, here's a good example of an income statement for our new shark attractant product. We're going to buy some property, plant, and equipment costing about $90,000. You can see on the depreciation line. That's how much the equipment costs. We're going to grind up the product, put it in bottles, and that cost $90,000 for the equipment for that. And we're going to straight line depreciate that to zero. This project's going to last, the equipment will last 3 years. And so we'll depreciate that straight line to zero. So the $90,000 divided by 3 is how we get the $30,000 of depreciation expense on this P&L. We think we can sell 50,000 units at $4 a unit. That's how we got the sales number. And we think we can manufacture this product for $2.50 a unit times 50,000 units or $125,000. Build that all the way down, tax it at 34%, and come up with an MPAT of $21,780. From that, we can quickly calculate the OCF using any of those 4 methods, because there is no interest expense on the income statement for this project. Then we build a balance sheet real quickly. Gross fixed assets are $90,000, $90,000, $90,000, $90,000. That does not change. From that, I have accumulated depreciation expense of 0, then accumulates 30, 60, and 90. And then my net fixed assets depreciate from $90,000 in gross fixed assets today down to 0 in net fixed assets by the end of the 3rd year on straight line depreciation. So it's very simple to do these 3. And then we would also add in any working capital to the statement of cash flows when calculating our CFFA, because it's OCF minus NCS minus CNWC. Remember, a full vertical income statement. Don't do it horizontally, vertically. Don't stop till you get the swoosh swoosh at the bottom. For obvious reasons, because if there's no interest expense on the income statement, I can go NPAT plus D to get a quick look at the operating cash flow. So in this case, MPAT plus D is equal to $21,780 plus $30,000 or $51,780. I'll get that for 3 years, $51,780, $51,780, $51,780. That looks like an annuity. And that cash flow will come in for 3 years because we expect this project to last for 3 years. The safe way to calculate OCF is EBIT, $33,000, plus D, depreciation, $30,000, minus T, $11,220, and that should get us to the same number for OCF of $51,780. Remember, we add back depreciation because it's a non-cash expense, and don't forget it's a very effective tax shield. So there's our OCF, calculated the traditional way, $33,000 plus $30,000 minus $11,220 gives us that same answer as the bottom-up approach of $51,780. We have to put some net working capital in, and when I do, I have to change that sign around and recover it at the end of the project. So whatever we put in to the project at time 0, in this case it's $20,000, we want to try and recover that $20,000 if possible. At the end of the project, we will shut the lights off in the building. We will sell all of our remaining shark attractant product inventory, and we will pay our bills, pay our accounts payable, and hopefully come up with that $20,000 again that we spent in the beginning of the project. So we need to put in these, hopefully the same number in our estimates with the opposite sign. So here you see your OCF, 51,780, 51,780, 51,780. You see your change in net working capital, which is $20,000 today I need to put up to get this project going, and I get that $20,000 back at the end of year 3. Finally, I need to note my capital spending of $90,000 out today with no salvage value. So my net cash flows at the bottom are negative $110,000 today, 51,780 in the end of year 1, 51,780 by end of year 2, and 71,780 by end of year 3. And then I do all that Chapter 9 analysis. From these, I can do the IRR. So right away, I write down in this project, NPV equals 0 equals minus 110,000 plus 51,780 over 1 plus some rate plus 51,780 over 1 plus some rate squared plus 71,780 over 1 plus some rate cubed. And then I can do, obviously, payback. Do I pay her back if the CFO gives me $110,000 today? Do I pay her back in year 1? No. Do I pay her back in year 2? Close, but no. Do I pay her back in year 3? Yes, sometime during year 3, I get that positive payback. So you can do all those methods we looked at in Chapter 9 to evaluate this large capital investment project. Remember to include changes in net working capital, and I want to look at it on a cash basis. So with my sales, I have to subtract any increase in accounts receivable, and with my cost, I have to subtract any increase in accounts payable, because I want to look at this on a cash basis, not just on a total sales and cost basis. So here I'm including net working capital into this decision. My sales in this example, 10.1, are $998. Cost on the P&L will be $734. And on the balance sheet, I'll have some inventory actually going down, and I'll have my accounts payable also going down. So I have to adjust my sales and cost for those changes in inventory and changes in accounts payable. So you can see I will, on my sales, my cash collections are $10 less. I'll reduce my sales to $988, and my costs were $734, and that's been overstated by $20 of inventory. So I'm going to subtract that amount from the cost, and I'm going to change the payables up $30. So my net cash costs are $744. $734 minus the 20 change in inventory, but plus the 30 in the change in payables, and I get a net cash flow of, or OCF, of $244. So basically, it's sales minus cost adjusted for working capital. Depreciation, we must remember, is two things. It is a non-cash expense and a very effective tax shield. So I want to accelerate depreciation as much as I can using legal, ethical, moral methods, a straight line being one of them. But a new one is called MACRS, Modified Accelerated Cost Recovery System, which is also legal under the, as per the IRS, under U.S. tax law, and it allows us to accelerate depreciation, which is good, again, because it's a non-cash expense. It also reduces our taxes. So the IRS provides us with a table on how to depreciate things. So if you have a car or a truck in your company, light-duty truck, you can depreciate that over a 5-year table, over 5 years. If you have some personal property you're using in your project, you can depreciate that over 15 or 20 years. Again, these numbers, these years change every year, so always consult your tax accountant for what these tables are. So what we do with MACRS, we basically take the asset value and we look at the depreciation given to us from the IRS, and we multiply those depreciation percentages times the cost of the equipment. Book versus market. The book value of the asset can differ from market value. In general, a capital gain occurs if your asset's market value exceeds the original cost, and if the book value exceeds the market value, which happens sometimes, then the difference is a loss, and the IRS actually gives a tax credit. Here's a sample problem you may encounter in MACRS. This project piece of equipment costs $12,000, and I'm depreciating it over a 5-year period, so the MACRS tables allow us to go 6 years. They give us some goodness, a higher percentage in the second year, and a little bit of goodness in the 6th year. You get a little tax deduction by depreciation in the 6th year. So on this one, if I would ask you, what is the ending book value at the end of year 4? It's about $2,073. Basically, you take the cost of the equipment times the percentages given to you. In the first year, you can see that depreciation percentage is 20%, and then that percentage goes up in the second year and then goes back down in the third, fourth, fifth, and sixth year, according to the MACRS percentages provided by the IRS. Eventually, that should zigzag down to zero, so I should be able to do several checks on this. My depreciation dollars should add up to the cost of the equipment, and my depreciation percentages should add up to 100%, and my ending book value should always zigzag down from the original cost of $12,000 all the way down to zero. If you don't get zero in the bottom right-hand corner of that table, you've probably made a mistake. Here's an example of 7-year depreciation percentages and values. And again, this is supplied by the IRS. Again, you get some goodness in the second year, a higher percentage, and you get some goodness in the 8th year, which normally wouldn't happen if this were a 7-year straight line. So again, get your MACRS percentages from the IRS and calculate. Here's an example of a problem. Staples Supply Company buying a new computerized information system, cost of $160,000, and we're going to look at a 5-year MACRS depreciation method or model. So again, you get the 5-year depreciation percentages from the IRS. If we're a straight line, it would just be 20, 20, 20, 20, 20. But we know with MACRS, we get a little goodness in year number 2, and we get a little goodness in year number 6. And so we take these percentages times the cost of the equipment, $160,000, and we calculate the various and sundry depreciation amounts. Those depreciation amounts should add up to the cost of the equipment, once again, $160,000, and then the percentages should go up to zero, and the net book value should zigzag all the way down from the original cost all the way down to zero. So that's how you know you've done your MACRS correctly. The depreciation amount should add up to the original cost of the equipment, as you can see on the table, $160,000. So do those checks whenever you're doing MACRS, get the percentages from the IRS. And what happens if this system is sold for $10,000 after year 4? Well, you look at your table and you see that your ending book value at the end of year 4 is $27,648. So your ending book value end of year 4 is $27,648. If you sell it for $10,000, you have a loss, and so you should get a tax credit for that loss based on your other taxable income. So that's the case where the book value is higher than the market value only being $10,000, book value still being $27,648. So you end up with a loss, and the IRS will give you a tax credit from this sale. So your cash flow, again, we want to look at after-tax cash flows. The cash flow is $10,000 plus the $3,706 in tax savings. That's 21%, your tax rate, times the loss of $17,648, which is the delta between book value and market value. And I get a $13,706 after-tax cash flow. And that's what the type of analysis we do on all these major capital investment projects. We're looking at relevant cash flows, we're looking at incremental cash flows, and we're looking at after-tax cash flow. So make sure you are thorough and complete in those analyses. Air Products, company I used to work for, back in the day has purchased a major processing plant. My plant used to be in Paulsboro, New Jersey, and Paducah, Kentucky at the time, in the catalyst division where I worked, costing $150,000 and depreciated straight line to zero over 10 years. The plant will be used in a 7-year project, and at the end of the project, we can sell it for some salvage value. Again, I want to calculate the after-tax cash flows for this project and see what it looks like. Again, what do? Income statement, balance sheet, statement of cash flows. I can key this into Excel according to this slide and see what the after-tax cash flows are on this project.